Welcome to Whitefield Industrials half-year results update to September 2022. I'm Monica Knight and I'm here today with Managing Director Angus Gluskie and Director Will Seddon. Whitefield's now in its 100th year of continuous operation. Profits after tax for the first 6 months of the 2023 financial year rose to $8.5 million, which is 6.7% above the prior year. This equates to earnings per ordinary share of 7.4 cents. Angus, could you elaborate on the contributors to earnings for this period?
Sure, there were three notable influences on our earnings for that first half of the year. So, importantly, we were encouraged to see dividend increases from around 50% of our investment holdings within the portfolio. So some of the larger increases included JB Hi-Fi, Origin Energy, WiseTech, Transurban, Computershare and Atlas Arteria. So conversely, we saw a reduction in dividends from the general insurers, as well as a small number of companies who had previously been beneficiaries of the COVID lockdowns. In addition, due to changes in our investment holdings across the period, we experienced some alteration in the timing around which we received our dividend income. Costs across the half year were tightly controlled, and as a result, we saw cost growth at a lower rate than the level of income growth we'd achieved. Now that results in an increase in our profit margin.
So Whitefield's declared fully franked dividends of 10.25 cents on ordinary shares and 131.25 cents on resettable preference shares. When will these be paid?
So the half-year dividend will be paid in December. Whitefield's maintained its ordinary dividend in line with our pre-COVID levels, despite many other companies in the marketplace cutting their dividends across this period. Now we've done that to provide investors with consistency of income flow. Looking forward, we'd expect that as our underlying earnings increase over time, we'll again get to a point where we'll be able to increase our ordinary dividend to our shareholders.
It's been a turbulent 6 months for investment markets. However, Whitefield's portfolio has outperformed its benchmark index. Can you talk to those outcomes, Will?
With interest rates rising sharply throughout the period, share markets around the world, including Australia, softened. Whitefield's portfolio return for the half year reflected this, with a return of negative 11.3%, which was a margin better than the return of the ASX 200 Industrials Index. The company's portfolio has outperformed this benchmark by 0.3% over 6 months, by 0.2% over 1 year, and by 0.5% per annum over the last 3 years. Stronger returns in the period came from our holdings in Atlas Arteria, Amcor, Brambles, Treasury Wines, CSL, ResMed and NIB Holdings. Whitefield benefited relative to its benchmark index through underweight exposures to poorer performing sectors in the period, including property, consumer discretionary, financials and technology.
Angus, rising interest rates and inflation are important considerations for investors at present. Can you comment on how this might influence markets in 2023?
Yeah, the cost of raw materials and energy has increased significantly over recent times. That's as a result of global trade disruptions driven by COVID lockdowns, as well as the Russian-Ukrainian conflict, and also the transition to more sustainable energy sources. In response, interest rates have risen, and this has also occurred as central banks have had to tighten their monetary policies and also reverse their prior quantitative easing strategies. As we move forward into 2023, we may well see an easing in some of the shorter term contributors to inflation. And this would certainly be a development that would be welcomed by investment markets. But as that happens, we should also remember that some of the more persistent drivers of inflation are likely to feed into a broader level of widespread inflation. And this would occur as some of the input costs and raw materials costs start to cycle into higher wage demands and back into prices. So this environment will create characteristics of stagflation. We'd expect to see some slowing in consumer and business demand, coupled with levels of ongoing wage and price inflation. Geopolitical disputes such as the Ukrainian-Russian conflict, as well as any other disputes out there, will continue to create an abnormally high level of uncertainty for investment markets. But it is worth remembering that a resolution of those disputes would be favourable for investment markets and likely to lead to a lowering of inflationary expectations.
And Will, does this affect the company's strategic investment positioning?
In these higher inflation, higher interest rate conditions, it's increasingly important to hold exposure to businesses capable of maintaining their profit margins and delivering a growing stream of income that matches or exceeds the rate of cost inflation. Generally, businesses in strong competitive positions providing highly necessary goods or services will be better positioned to do this. And so we continue to orient Whitefield's investment portfolio towards businesses with those characteristics. At Whitefield's half-year end, the company was holding an emphasis towards consumer staple, chemicals, bank, industrial and healthcare sectors, and these exposures in part reflect those background strategic considerations.
Thanks, Will. I can see the logic there. Now, Angus, the 2022-23 year is Whitefield's 100th year of continuous operation. Are there any lessons from those 100 years that are particularly pertinent to present investors that you could touch on?
So, as Will just noted, it is important for investment portfolios to be progressively adjusted towards the sources of ongoing sustainable income growth. And if we look back over the last 100 years, Whitefield was able to benefit in the 1920s from the strong surge in consumer and housing growth of that time. In the 1950s to 80s, the company benefited from the very strong population growth and productivity growth evident in that time. And more recently, the company's been able to benefit from the trends of globalisation and technological development. Our processes of continuous stock assessment and adjustment of the portfolio have allowed us to navigate and benefit from the very meaningful changes that have occurred economically over those timeframes. Now, this dynamic ability will continue to be important, particularly as we go forward into a reasonably rapidly changing environment.
There's certainly a lot of businesses that have come and gone in that time. Are there any other insights you can share?
So it's certainly better to generate and compound steady increments of sound return rather than chasing unsustainably high returns. So that former approach represents a very efficient use of risk to generate return. And it's that thought or that strategy that sits at the heart of Whitefield's approach.
Thanks, Angus. That brings us to the end of our half-year update. We look forward to reporting to investors with our outcomes in future quarters. For more information about Whitefield, please visit our website, whitefield.com.au, or see our financial statements released to ASX.